Good morning. Welcome to Trading Hour. It's a Tuesday morning. I'm Reema Tendulkar. With me is Surbhi Upadhyay, and we're seeing some very, very quiet sideways moves on our market. The Nifty and the Sensex mildly lower. The advanced decline ratio, though, is a bit disappointing, firmly in favor of the losing side. So we've got about 2 stocks gaining for 3 in the red, but lots of individual stocks, right? Particularly outside of the index, whether it's BEL or Balkrishna Industries, where there have been multiple upgrades. REX has seen some upgrades on the way down. You've got Delivery, which is stand close to about 8 to 9%. So lots of individual stocks are catching your attention this morning.
Absolutely, Reema. Yeah, I think on the large cap screen, if there's only one trend that we can call out this morning, that's metals. Because largely speaking, whether it's ferrous stocks, non-ferrous stocks, a lot of the metal counters are up and about. Some examples would be the likes of Hindalco, JSW Steel, Tata Steel. So they're all up. Coal India itself, by the way, which obviously is, a very important link in the entire, power cycle. That's been the other one from the PSU basket, which is up about 3.5%. SBI is up about, 1%. So 2 trends that we can call out. One, metals are doing well. And the second, PSU stocks continue doing well. In fact, speaking of PSUs, I just want to call out some other names. Reema mentioned BEL. That's because of the result reactions, and we'll get to the BEL numbers in just a bit. Just like a lot of its other counterparts from the PSU space, BEML, for instance. I mean, the good momentum of earnings is resonating. HAL, BEML, and BEL, and all those stocks have gotten rewarded really well. If I talk about some more PSUs beyond this name of BEL, RVNL, Aircon, SJV, it's a long list of, winners actually once again on the PSU screen. The gains aren't absolutely ecstatic, but you've still got 3, 4, 5% depending on which stock you're picking up. So actually it's not a bad show at all. And then some of the mid-cap movers. The mid-cap market as a whole, by the way, is not rallying today. We must keep that in mind as well. The mid-cap index is absolutely flat. The advanced decline ratio is actually favoring the declines. So yes, you have the outliers like a Balkrishna or a BEL like we've been discussing, but otherwise it's a fairly quiet morning so far in the broader market as well. We must take that on board. We'll discuss, of course, some of these key movers and shakers with all of our colleagues and with our experts as well. In fact, let's... Okay, in a bit we'll actually get Vivek in to tell us more about some of these stocks that are moving. Talk about some more gainers on the screen beyond, the PSU names and the metal names that we mentioned. There is a Cipla, there is a Apollo Hospitals, there's a Divi's. So a little bit of pharma and healthcare is where there's a bit of green, not too much, but, a little bit here and there. But then you've got a lot of disappointment on large stocks like TCS, HUL, ICICI Bank, L&T, ITC. There are too many heavyweights, too many of the big boys, which are on the red side of the screen. So that's the way it's, right now cutting up. But as promised, let's get you more details on BEL and why that stock is up almost 6-7% after numbers. We have Vivek joining in with the fine print. Vivek, what has worked for BEL?
Well, good morning. Clearly the stock of the day, and in fact, if you've been looking at the screen, the stock of the week in terms of the week that just went by. What is it that's driving? Like we mentioned, Q4 across all parameters, it's a clean beat. Along with that, the order inflow guidance is something that the management has surpassed. Margin, band guidance is also something that the management, surpassed as far as FY24 was concerned. Along with that, remember, quant analysts are started to pencil in that Bharat Electronics BL could enter the Nifty in the next Nifty region. Of course, it's still some time away, but that also could lead to increased flows as far as Bharat Electronics is concerned. But let's have a look at Q4 and FY24 and how exactly it panned out. Number one, like we mentioned, across all parameters, it's a clean beat. Along with that, the order inflow for FY24 was close to 35,000 crore. What was the management guidance? Just around 20,000 crore, and even that was an increased guidance. So clear, handsome beat across what the poll and the street was anticipating. As far as the order book position, very, very strong, close to 75,934. Q1, Q2 expect some softening as far as ordering activity is concerned as the election process is underway. Brokerages, as expected, are quite enthused, after the strong set of results. Jefferies has gone ahead and raised its target price. They continue to have a buy rating on the stock. They're saying that the EBITDA was 30% above what they were anticipating. They're saying that the company will continue to benefit from spends across Army, Navy, as well as the Air Force. Nomura also has a buy rating. The target price is close to 300 rupees a share. They're saying that operating cash flow was almost 4,600 crore, up from almost 1100 crore in FY23. Order inflows was also above what the street was anticipating. And Morgan Stanley too, as a overweight rating on the stock, they're saying that the FY24 margin of 24.9% was significantly above the 21 to 23% margin band that the company themselves have indicated with. So strong, beat as far as Q4 is concerned, and also all brokerages have gone ahead and upgraded their target price.
Okay, thank you very much for that. That's been one of the big winners. And the other one, as we pointed out, was Balkrishna Industries, where the numbers look good. A revenue growth of 15%, margin expansion. The stock is currently at about 3,040, but Nomura, which has upgraded the stock to a buy, has pegged the target price at more than 3,200. And even IFL sees a 19% upside in the stock, and their target price is at about 3,025. The stock has run up in the recent past, but brokerages do see a lot more upside in the stock. Sudarshan Chemicals is the other one. It's up 12% on the back of positive commentary by the management in the investor presentation. Sonal joins in with the key highlights. Hi, Sonal.
Hey Rima, well the numbers were reported on 17th of May, but last night is when the company updated its investor presentation, and there is some positive commentary coming in there as well. Of course, it was the highest ever income from operations in Q4. The company says it was led by healthy growth in domestic sales. Their operating leverage with YOY volume growth this time around is something that led to highest ever EBITDA as well for the company. The export revenues were up just 2% on a YOY basis. The domestic revenues, however, were up 15%. And there was a good sequential recovery in export revenues on a quarter-on-quarter basis, and that is something that the street likes. 23% on a quarter-on-quarter basis. They are seeing improvement in Europe in terms of sales, while the momentum continues in North America as well. Going forward, they are monitoring the crude oil prices and potential impact on any other intermediary prices as well. Not only the P&L, even the balance sheet has improved for the company. The cash conversion cycle has improved to 66 days versus 74 days on a YOY basis. The net debt to equity has reduced to 0.3 times versus 1 times on a YOY basis. And in terms of their domestic market share, it continues to be stable at that 35% mark. Going forward, the company says they are looking at shifting towards higher share of specialty segment and also continue to expand their product portfolio. So good numbers followed by good commentary is something that the street likes.
Okay, absolutely. The stock was rallying almost 14-15% at one point. And now it's cooled off a little bit. Sonal, if you're with us, just for some context, Sudarshan is now saying that they'll move to specialty chemicals in a bigger way. That'll be a bigger kicker. But as of now, what would be the biggest segment for them?
So not specialty chemicals, basically they will be moving towards specialty pigments. They are largely producers of pigments, and in that they would like to move towards specialty pigments, which would be their bigger segment going forward, and that would lead to higher margins as well.
Okay, got that. Thanks very much. So that is Sudarshan Chemicals. Was listening to Vinati Organics earlier. Very different segment, obviously, but even that is a company in the chemical space which is talking about a recovery ahead, at least for its product portfolio. So some of these chemical companies are chemical dyes, pigments, very, very different, obviously, segments. But they're talking about business getting better from here on. And obviously, the stocks have been big underperformers. So any pivot is working really well, as is the case. Vinati now on day's high, and Sudarshan is anyway having a big, big run. Well, let's take the conversation forward with Varun Lohachab of HDFC Securities. Varun, great to have you on the show. Thank you very much for joining in. So yes, of course, we want to get your take on earnings season, almost in the last leg. And do throw in a word on some of these chemical companies, specialty chemicals, dyes, pigments, agrochemicals, and whether you have noticed any sort of signs of recovery and whether you are looking favorably at any part of the space.
Sure. So firstly, quickly on the earnings season, overall, it was largely on expected lines, I would say. If you see, earning growth has been around 16-17% for our coverage universe for the companies which have reported so far. Still, there are some results to go. So at the starting of the earnings season, we were in that same zone of 18 to 19% sort of expected earning growth. So by and large there, obviously, sectorally, there were quite a few hits and misses. So industrials did very well. We were expecting it to be good, but it was stronger than expected. IT was obviously weaker than expected. Cement was on the weak side. So largely continuing with the trend, but the extent of beats and misses, were slightly exaggerated. In terms of going forward, specifically on chemicals, we did see some bottoming out of numbers on the specialty chemical side. The pricing pressure most of the companies are talking of things at least bottoming out, if not recovering meaningfully. In terms of earning downgrades, they were still there in chemical sector for us. So they were around 5 to 6% earning downgrades. But if you look at last few quarters, the pace of earning downgrades was far higher at around 10 odd percent. So in that context, it was, I would say, slightly some signs of bottoming out are there. And in terms of within that segments, we believe agrochemicals possibly looks slightly better placed compared to specialty chemicals. Probably the recovery could be faster out there. So yeah, that's our overall view. We were underweight chemicals. We are still underweight, but we are getting slightly more constructive at the margin. Yeah.
Varun, from some of the stocks that you recommend, like a Tata Power or L&T, the Q4 numbers were slightly negative, particularly on the margin front. So both L&T and Tata Power, the stocks that you recommend in the large cap space, disappointed on the operational front. How would you approach these stocks? So when we got the dip, did you recommend increasing allocation to these stocks, or have you changed your weightage for these two particular names in the model portfolio?
Yeah, so we are continuing with them. Anyway, if you see the context of the report in which we had named these companies, it was more from the next 3 to 5 year view. We are quite positive as a house on the overall manufacturing and capex story, both public capex continuing and private capex picking up. So there are a whole host of stocks. We also like Cummins, but L&T, Tata Power, we believe look good. Tata Power more from the the strong power demand and the transition towards green energy. That again seems a secular theme. So these are 3-5 year stories. You will get these quarters when there will be misses. In case of L&T, I think margins. It looks like that probably the pricing power is still not there, and therefore the margin downtick was slightly higher than expected, but it's getting compensated with very strong order inflow. So we believe now, Street has reset their margin assumptions lower, which was one of the reasons why last couple of quarters there were sort of downgrades on L&T in terms of earnings. But from here on, it would be more top line story. So from a 2-3 year perspective, we are positive. We continue to hold them in our model portfolios, and any dips we would like to add further. Frankly, so far they have not dipped much for us to get overly excited to add more positions, but happy to add them on any dips.
So that would be, something like an L&T. What else, Varun? I think, Siemens is on your recommended list as well. And some of these, industrials, MNC industrials, they've had a great quarter, ABB and Siemens. We remember that whole rally that took place over the last 4-5 sessions. What is your view now?
Yeah, so both of them had blowout sort of earnings, especially margins. Now you're seeing, operating leverage coming through with strong top line. Margins are also improving, which was our call. We believe, near term, obviously the earnings are slightly now looking, the run up has been very sharp. Earnings, the valuations are looking slightly punchy, but from a 2-3 year perspective, we believe growth will remain very strong. So Siemens and Cummins, these two are our top picks in the capital goods space.
Okay, just Varun, to round up the conversation from where we started. Tell us, what is your expectation, earnings projection now for FY25 and FY24? Now that we, more or less have all the numbers, where were you before Q4 and where do you think we'll finally end? So just to get the sense of the, the upgrades, if at all.
No, so Q4, as I said, was largely in line, possibly based on the numbers so far, just a 1% cut is there. So FY25, we are, at around 13% earning growth for our coverage universe, which is largely unchanged in this quarter. There's a minor 1% kind of a downgrade to our FY25 estimates, but FY26 has seen 2 to 3% upgrade as well. So largely we are in the same ballpark region. 13% earning growth in FY25, which is getting pulled down a little bit by oil and gas. If you X that out, especially the OMC earnings, which were very high in FY24, then possibly we are in the 15% sort of a zone for earning growth for the broader market. And we believe, that will continue in FY26 as well. But we won't be into, the last 4 years has seen 20% plus kind of earning growth for Nifty and broader markets. From those levels, we are going to see some moderation in growth, and therefore, it has to be very bottom up and stock specific, and at a overall index level, maybe returns may not be as high as what we saw in the last.
Got it. So 15%, Nifty 15%, right?
Close to that.
For FY25, close to 15%. Got it. All right, Varun, thank you very much. Good to have that perspective. Really appreciate you joining us on the show today. That's a view from HDFC Securities coming in. We do have to take a break on that note. Come back on the other side, and all the latest in the commodity markets coming up with Manisha Gupta. Welcome back. Well, we've been telling you about the big buzz in the metal space, and there's a lot of talk about copper prices hitting all-time highs again, breaching previous levels. So that seems to be keeping the excitement going on the non-ferrous side. But let's see what Manisha has her eye on. She's joining in for a roundup of all the commodities action. Those are, of course, some of the local prices on your screens. Manisha, hi, morning. So what's making it to your list today?
Well, I'm looking at precious metal prices because we totally missed putting this out yesterday. And, we have seen the silver prices continue to gain in the day-to-day as well. While we have seen $32 an ounce on the higher side there, and then there has been a bit of a profit taking on your screens right now. But even these levels of 93,000 are near all-time highs. The all-time high that we've done in the Indian markets is at 95,000. The low for 2024 has been 67,000. So 67,000 to 95,000 of a run-up clearly has been almost 30,000 rupees per kg of a run-up in case of silver. When you look at the commodity, well, we have seen an outperformance come in for this one for the month of May and for 2024 as well. While, of course, the all-time highs in gold have had their rub-off effect, it also has been about the geopolitical tension, especially in the Middle East, whether it has been statements from Israel on what has happened in Iran, and then, of course, the Saudi king not keeping well in sense of health. So the whole Middle East actually seems quite uncertain in sense of political issues there. And then the markets also have seen weaker U.S. economic data, the decline in dollar index, possibility of a rate cut by the month of September, all of that supportive as well. And then comes the metal part of it, because we are looking at a fourth year of deficit in silver, and this year the industrial demand is expected to hit an all-time high for a fourth straight time in 2024. So those are various supportive factors that you will see in case of silver continuing to support the prices going forward as well. I quickly want to take you on what India has been doing in sense of importing silver. So the month of Jan actually wasn't so strong, but the month of Feb has seen 2,000 tons of import in silver. April has been on the stronger side as well. And total imports in India right now stand at 3,943 tons, which is higher than all of last year as well. So clearly strong buying returning back in case of silver there. Also, when you look at the price returns there, while gold has given you 16% of a return in this year until now, silver has given you 26% of returns already. So very strong going, continuing in that space.
Okay. I don't even know if there's a silver lining to this news from a buyer's perspective when we're talking prices. 96,000 in the Indian market, right? Manisha, you said?
Yes. And the low for this year has been 67,000. So
talk about that range. It's a pretty wide range and a massive rally. Thank you so much for putting that on, on our radar as well. So silver definitely sparkling bright. Well, let's take a break after that. We'll come back on the other side, get back to the equity market and get you some trading ideas with Vishal Malkan. Welcome back. Well, we promised to tell you more about individual stocks that are buzzing today, despite the market being a little lackluster. Well, two such stocks are Kalpataru Projects as well as IEX. Kalpataru Projects, of course, they got some orders from Aramco, and now they've given out the details on these orders. And the quantum looks fairly large. Not Kalpataru Power, we should pull up Kalpataru Projects. And that's a stock that's been up about 6-7% because of that development. Let's go across to Vivek. He is tracking both the companies for us. Vivek, let's start with Kalpataru and then tell us about IEX and what's happening there.
Well, that's right. So Kalpataru Projects International is the company that we're talking about. So, what we need to understand is, number one, this is not a fresh development that the company has intimated the exchanges. In fact, before March 5th, CNBC-TV18 had put out a report saying that the company most likely had emerged as L1 or the lowest bidder for 3 projects in the third phase of the master gas supply, which Aramco is undertaking. So now on March 5th, the company did intimate to the exchanges that yes, they had received the LOI, but they had not given out the quantum and they had not disclosed the quantum. So what's actually happened overnight is the fact that the company has said that they've gone ahead and signed 3 contracts for 3 packages of the third expansion phase of the master gas system network in Saudi. The total contract value of these orders is over 7,500 crore. This is quite significant as far as Kalpataru Power is concerned. And also, keep in mind, this particular order win that comes in actually helps the company go ahead and go ahead and apply for more projects and participate in more tenders as far as entire Saudi is concerned. Now, coming to IEX, what's actually happened is that IEX, the results came out last week. We had the management on our channel. The management did tell us that as far as market coupling was concerned, there had been slow progress that happened as far as the testing projects or the phases that were being conducted. But what's happened after the analyst call is the fact that there have been a couple of brokerages that have gone ahead and upgraded the stock. Investec has upgraded the stock to a buy rating from a hold. They're saying that over the past few years, IEX has faced several regulatory headwinds and supply side challenges. They're saying that the exchanges actually saw lower than anticipated volumes as well as earnings growth. And along with that, the company faced and the stock faced valuation derating. But now they are saying that one of the biggest problems or the biggest risk as far as IEX was concerned was market coupling, and the market coupling progress has been slower than what was being previously anticipated, and that gives them the confidence to go ahead and upgrade the stock. Axis Capital too has gone ahead and upgraded the stock to an add rating. They're saying improved growth outlook for the exchanges has made them go ahead and raise their FY25 and FY26 EPS estimates by 5% and 6.5% respectively. They are saying that this is a tactical opportunity to make returns in IEX by riding the power demand growth and improve liquidity as far as the exchanges are concerned.
Interesting. So brokers basically seeing an opportunity after the kind of badgering the stock like IEX got because of regulatory issues. And this market coupling was seen as a massive disruptor issue. But perhaps it's going to take some time to implement. Got it, Vivek. Thanks very much for explaining that to us. So IEX also on the upside today. Well, speaking of stocks in focus, there's also Balkrishna Industries, which is on our radar. Now, the company came out with what looked like a good set of numbers for the fourth quarter, but brokerages are still sounding cautious. We have Sonia joining in to explain to us why. Sonia.
Well, thanks a lot for that. So, the stock is up almost 10% because the numbers were very strong. There were no two ways about that. It was a strong revenue and margin growth. But let me tell you what brokerages are saying right now. It's a mixed bag this time around. So, most brokerages have a sell call on the stock. Kotak has a sell, Citi has a sell, Motilal Oswal has a neutral. The only one that is quite optimistic is Nomura. They've upgraded the stock to a buy. Now, there are some reasons for caution. One is that the company did not give any guidance for FY25. In fact, they said it's too early to give a guidance because of the geopolitical scenario. They also spoke about how some raw material costs have surged, primarily rubber and crude prices, as well as there's an increase in freight costs. But the reason the stock is up and about is because it was a very strong quarter for the company. Double-digit revenue growth is what the company has clocked in. The margin performance has been very strong as well. And overall, if you look at the volume growth, it's returned back to double-digit, up almost about 13%. If you look at what Nomura is saying, since Nomura is the one that has upgraded the stock, right? Just let's get back to that one. They talk about how the growth for the business is pretty strong for Balkrishna Industries and how, the worst in terms of the downtick could be over for the company. In fact, they also talk about how the growth momentum will continue, price hikes will support the margins, and globally agri prices have started inching up and should drive replacement demand from here on. They also speak about how at 15 times FY26 EV to EBITDA, the stock is quite attractive compared to some of its peers. So that is the optimistic view coming in from Nomura, and that is perhaps one of the reasons why the stock is up almost 10% today.
Okay, thank you very much for that. Vishal Malkan of MalkanView.com is also with us on the show now. Vishal, morning. Thank you for joining in. Quiet, though the Nifty is now clawed itself back above the 22,500 mark, so managed to put its head above in the green line. First, your thoughts on the day so far, and what would your stock recommendations be?
I think we are positioned strong on the Nifty and Bank Nifty above those levels of 22,400, 500, which is strong support. Maybe we are waiting for the big day for the big announcement in the next week. But meanwhile, stock specific, there are a lot of opportunities, especially in the metal and the power sector, which are looking very good.
Okay. Vishal, just elaborate on that. I mean, specific calls, stocks that you're looking at, and of course, the view on the index as well.
Yeah, so for Nifty, I'm looking at the next resistance is around 22,800, which could be a strong resistance because that has been tested a couple of times, and I think it can only cross after once we have the big announcement. And for Bank Nifty, we are looking at targets of around 48,700 to 800, which could be a short-term resistance. And for the stock-specific movement, I would go with a breakout on Motherson Sumi, which has given a nice breakout above 130 levels, and I think it's poised for 145 to 150 in the next few trading sessions with a stop loss of 127. And second one would be, I would go with Indus Tower, which is consolidating since last few days, but looking like a breakout on the intraday chart. So look with a stop of 335, targets of 366 and 375.
Thank you, Vishal, for joining in. Get into a break. On the other side, we get you excerpts from our conversation with Amara Raja Battery CMD Jaidev Gala. Stay tuned. Welcome back. Now let's get to the news from the insurance space. We understand that Niva Bupa is eyeing a D-Street debut soon. They will be filing for a DRHP with SEBI. Yash joins in with the details. Yash.
Well, Reema, we've seen a very long lull when it comes to primary market action as far as the insurance sector is concerned, but that seems to be picking up. You know, just last week we had the Go Digit Insurance IPO closing, and the latest that we've picked up from our sources is that Niva Bupa Health Insurance is also eyeing its debut to the exchanges. What we've been given to understand is that Niva Bupa Health Insurance is expected to file its IPO DRHP with market regulator SEBI, and that could happen by the end of current month, that is May end or early June itself. As far as the size of the IPO is concerned, it's a large issue. The company plans to raise a total of about 3,000 crore rupees through a combination of fresh issue as well as offer for sale. The fresh issue part of the total 3,000 crore approximate amount could be about 600 to 800 crore rupees, whereas the offer for sale part could be in the vicinity of 2,200 to 2,400 crore rupees. Remember, Niva Bupa Health Insurance will be the second standalone health insurance company to list on the exchanges after Star Health Insurance. And as far as the OFS or the offer for sale part is concerned, True North SPV, that is Indian Fetal Tone LLP, is likely to be a large seller as far as that OFS component is concerned. True North currently holds about 28% stake in Niva Bupa Health Insurance. Bupa Singapore Holdings, that owns about 63% stake in the company. Just last year in September 2023, True North had sold about 20% stake in the company to Bupa. That was for about 2,700 crore rupees. And that particular transaction valued Niva Bupa Health Insurance at about 13,500 crore rupees. When one looks at the financials for Niva Bupa Health Insurance for FY23, the net earned premium for the company was up 52%. The total income was up 50%. Operating profit, that was down 23%. Underwriting loss was down 53% in FY23. Net profit, that came in at about 13 crore rupees versus a loss of 197 crore rupees. Importantly, combined ratio for the company, that stands at 97 versus 107 on a year-on-year basis. Now, when compares Niva Bupa to Star Health Insurance, it's a much smaller company. Star Health's net earned premium is 4 times bigger than Niva Bupa. Star Health's total income is about 3.7 times bigger than Niva Bupa. Star Health's operating profit is 2 times bigger than Niva Bupa. But as far as combined ratio is concerned, that is the operating part of it, that's more or less similar. Niva Bupa's combined ratio, Star Health's rather combined ratio is 95.33, whereas Niva Bupa is about 97. Just for a reference point, once the valuations for Niva Bupa are disclosed, Star trades at about 4.8 times price to book value. It remains to be seen what kind of valuation does Niva Bupa come out with. But the reference point would be about 4.8 times price to book value.
Okay, all right, got that. Thank you very much for all of the details there, Yash. Well, with that, we do have to move on. Amara Raja is planning huge investments for lithium-ion cell manufacturing in Telangana. Speaking to CNBC-TV18's Parikshit Luthra, CMD Jaydev Gala says that the company will invest around $1 billion in the next 3 to 5 years for this project. Take a look.
Well, I think we've made quite a few announcements over the last several months about our investment plans of getting into lithium-ion cell manufacturing with a huge investment in Telangana. So that is ongoing, and we'll be implementing that project in phases. We're expecting that in the next 24 to 36 months, we're planning to spend more than we've spent in the last 30 years. So it's a huge investment phase for us, recognizing the growth that's happening in the country on multiple fronts, especially in the electric vehicle and energy transition that's taking place. We have, that's the area that concerns us directly.
Any ballpark figure on investments over the next 2 to 3 years that you could give us?
Yeah, well, I can say in the next 3 to 5 years, we're expecting to invest about $1 billion in lithium-ion cell manufacturing capacity.
Now, in terms of attracting capital flows into India and bringing more electric vehicle manufacturing into the country, what more is needed?
I think it's on track right now. There's a lot of interest happening. Original equipment manufacturers are rolling out their vehicles. Different models are being introduced. The government is relaxing the import duty on larger vehicles so that people like Tesla and others can start bringing cars into India before they start manufacturing. Ourselves and many others are looking at getting into the advanced cell chemistries like lithium and others to make not just the packs but the cells that go into those products. So I think the ball is rolling, and we just need support from the government to ensure that there's no roadblocks placed.
Have you applied for the ACC-PLI scheme, the phase 2?
Yes, we have applied for the phase 2, and we're hopeful of being successful in that.
Okay, all right. Well, with that, we have to get into another quick break. We'll be in conversation with the management of Anupam Rasayan on the other side to talk about the company's Q4 performance and the outlook ahead.
Okay, let's get to a corporate conversation now. Anupam Rasayan is in focus on the back of its Q4 numbers. The company's posted a strong recovery on a sequential basis. Though, if you look at the numbers on a year-on-year basis, there is some weakness. Gross margins have declined, on a quarter-on-quarter basis. So that's a bit disappointing. The stock on the whole is on the flatter side, down close to about 0.5%. Vishal Thakkar, Deputy CFO at Anupam Rasayan, is with us on the show now. Thank you very much for joining in. First, if you could just give us the big picture guidance on the demand environment, the outlook as you enter FY25, and what could revenue growth and margins look like this year?
Hi, good morning, and thank you for getting us on your channel. Let's talk about the overall market. See, the overall market, if you look at this year, FY25, we think it's a growth year for us. However, if you look at it, the first half looks little challenging as we enter this year, because last year, if you look at last 6 months, has been quite where we have faced headwinds for all the industry. And we believe that for the agrochemical industry for the next 6 months, maybe there will be a bit of a headwind there. But if you look at it from a pharma and polymer side, which is where we have been seeing a reasonably good growth in this year, we believe that this growth will continue for the next next year onwards. Also, in that if you look at it, FY25 should look a growth year. And once the pharma agrochem comes back, probably the growth will be far stronger and robust as we go. Maybe entering the 2026, the growth should look far more robust from there.
So FY25 yeah, go ahead.
Go ahead. On the margin side, we believe that the margins will be similar to what we have been seeing in the historical, where we've been guiding. 26-28% is where we should be looking at, which have been the past. And especially with the business model that we have, that kind of numbers look reasonable for us, because a lot of our costs are, or most of our costs are passed through, and hence we are able to maintain that margins. I would say.
Mr. Thakkar, I mean, just to take that point on agrochemicals a little further, you just said that next 6 months look a little challenging on agrochemicals. Just, go into a little more detail over there, because I believe that's the biggest segment for you. It's about 65% of your revenue. What are the challenges you're facing? You were just speaking to one of the stock market analysts, and in fact, the market seems to think that agrochemicals will perhaps show one of the best recoveries. So what's really happening in the market?
So again, I said the year, if you are talking about, is a different story. I agree with the analysts that they're saying that yes, there'll be recovery. But if you look at the first two quarters, if you really look at it, it's going to be a little bit on the side where the demand will be tepid, and also if you look at the pricing, will be more on the flattish side. And hence, we think that the first 2 quarters we'll be cautious in terms of demand and demand growth. But 2 quarters later, the third and the fourth quarter, which is typically entering the CY25 for the international customers, will be the time when we will see a stronger growth coming in from there on. So that's where we are trying to say that first 2 quarters we'll be cautious about our growth and demand.
Got it. So basically, you're saying that the recovery in agrochemicals probably is going to be back-ended. So just to break up the sequential recovery you saw in the fourth quarter, where your revenue was up almost 35-36%, did that come in from the pharma segment, or which segment sort of resulted in it? And how much was volume? How much was pricing? Just basically give us the volume and pricing trends for all of your segments. We've discussed agro, but the other segments as well.
So I'll put it in a simple manner. If you really ask me on the split side, split was similar, but we had launched 17 new molecules in this year, and more than 6 in the last quarter. So that typically when you launch, it takes you a few quarters or some time to really pick it up, and that also has contributed to my revenue. 2, if you look at it, largely the recovery is coming from the volume rather than only from the pricing. Because pricing, I think, is if you look at the pricing environment has been pretty flattish, deflationary to flattish, so we don't see pricing to be coming up big time. But volume recovery is where it is, and especially from the new product contribution has really brought this growth, if I were to say. And 2 is also you have to see most of us, agrochemical industry is more a cyclical one also. So part of the recovery you will see is more coming from the year to year, because if you look at a YOY is where at times also you have to be conscious of that along with the sequential growth. So that's where I will put it.
Okay, got that. Can you talk about your working capital days? Because they worsened in FY25 to over 300, and in the past you've guided for about 220. What went wrong? Question 1. And 2, in FY25, what would the working days look like?
Okay, let me give you first in terms of yes. If you look at the environment itself, what has happened is there has been a sluggish demand, and that sluggish demand led to two or three things here. 1, I had to offer a more extended credits to my existing customers, which led to my debtors expanding. 2, because of the lower sales or sales velocity, my inventory unwinding has been slower or not where I wanted. And 3 is absolutely because my revenue has dropped by let's say 10-12%. It also impacts the numerator-denominator phenomenon and number of days to that extent. Even if I'm flat on my working capital, it gets deflationary. Whereas what we had when we went into the year, we had expected around a double-digit growth. So had that double-digit growth come in, we would have been better off. But that's where we are, and we think that FY25 we should be able to improve these numbers.
So you get to about 250, or do you get back to 220 now that you are gunning for growth in FY25?
Give me a quarter or 2 to give you the annual numbers.
All right.
But yes, it should be in that direction. Direction is true. The extent let's examine, because how the market also pans out is something that I would want to see before I guide this time.
Chal, a quick word on the newer segments, defense, battery, chemicals. What's the capex that you've set aside? When does it start contributing?
So if you see, we had announced a capex of 670 crores. That capex is good enough for doing all what we have talked about: newer chemistry, newer applications, battery, be it defense, be it polymers. All that will come into that portfolio itself from those products, from that factories itself. And those plants, we expect that in H1, by the end of H1, we should be able to be up and running, and that should start contributing in the second half or going forward from then on. So any new capex? No, we don't see any significant capex to service whatever we have planned today.
Mr. Tucker, we just have another 30 seconds, but our colleague who tracks your company and sector more closely is just asking us to check this. Apparently, you had a LOI pipeline of close to 8,900 crores, out of which 820 got converted to contracts. But it seems that rate of conversion from LOI to actual contracts, that's really diminished. So what explains this, and where are you right now in terms of LOI and then actual contracts?
Okay, so let me give you in a very different manner. If you look at it, the 2 years back, we had signed around 2,600 crores of LOIs and contract, which should translate to around 450, 500 crores of revenue from there. Okay, and typically these LOIs and contracts will take 12 to 24 months to really get into commercialization, and then it takes you a couple of years to ramp up fully. Right, so it's a 2+2 kind of a time period that you should be looking at. So the numbers that we had signed in 22, if you look at that, we have done around roughly in the range of around 200 or a little less than 200 is the kind of revenue that we have generated from there. So if you look at it, we are on the ramp up period. Yes, that ramp up has been a little slower than what we would have expected because of the environment that we are in. But other than that, we see that the LOIs are. So see, another thing is that if you talk about LOI or a contract, they both mean the same to us because these are the customers who are top-notch customers who would not ink on the paper till they have crossed the T's and dotted the I's. So to that extent, I don't see too much of a variability coming from that side. Yes, the ramp up has been a little bit pushed out for the reasons that we have talked about in the earlier part of our conversation.
Thank you very much, sir, for joining in. That's Anupam Rasayan. After a near 8% decline in top line in FY24, the company is now looking for growth in FY25, though it will be a bit back-ended. PSUs are doing very, very well. Look at RVNL, 13% up, SJVN, 9% up, IRCON, 8.5% up, HUDCO, 7.5%. We already spoke about BEL, but the entire PSU basket, as you can see, has been flying and picking up pace in the last few minutes. Get into a break. On the other side, Soumyajit Neoge from India Ratings and Research will join in to discuss the rise in related party transactions, and is this a worrying sign for India Inc.?
Welcome back. Well, let's get to that interesting note that's come in from India Ratings and Research. And this note says that an increase in related party transactions with outside parties, despite a benign credit environment, perhaps exposes entities to uncertainties on returns as well as additional cash outflows in case we hit a slowdown patch. To talk about this, we have with us Soumyajit Neoge, Director at India Ratings. Soumyajit, thank you very much for this call. So, the report that you came out with was very interesting because that's true. I mean, any sort of stress, related party transactions, a build-up in leverage, all these things have kind of moved away from our memory and mind because we've been in a very benign environment and credit quality and credit environment. But just tell us, what is this rise in related party transactions that you're seeing? What do you make of it? And why are you concerned?
Yeah, thank you very much for invitation. Let me first clarify one thing, that although the rise in RPT is surprising amid benign credit condition, but not all RPTs are necessarily concerning. So like investment in JVs to foray into new segment as well as de-risking own balance sheet could be a part of the risk management philosophy of those anchor investors, and which is good in a way, it is not bad. But however, investment into entities where control resides with the promoter, sponsor, and have no strategic imperative, there is no clear-cut economic interest, these are concerning, and these chances that this could expose to the entities in additional cash outflows in the future and suboptimal return for the stakeholders, especially for the shareholders.
Okay.
So what the analyst, yeah, sure.
Just to take a step back, what's been the increase in related party transactions? Do we have a number?
Yes, exactly. So if I compare with the pre-COVID period, precisely FY 2018, we have done this analysis for more than 2,500 entities. And out of 2,500 entities or more than that, so we have found out in FY entities around 679 entities where actually disclose related party transaction. And here we need to caveat one thing: the related party transaction, what we have accounted for, which are purely outside us, not within the subsidiary, which is good. And in FY23, the number rose to 746 MT, which is not high. But in terms of the quantity, that time the total amount was around 9.5 trillion, which is currently at the 16 trillion. If I just put another perception, this 16 trillion RPT for the revenue of the total sample set is around 100 trillion, and the debt size of around 32.45 trillion.
So, Mr. Somajit, you are obviously worried about, as you said, related party transactions that are not happening within the company's own subsidiaries framework.
Right.
But these would be RPTs that are happening with other promoter entities, and what kind of companies are we talking about? I mean, AAA, SME, mid-size, what kind of companies where you're seeing this rise in related party transactions?
Right. So obviously there are the segregation that it is RPT group companies, RPT associates, enterprise under management, and RPT joint vendors. So interestingly, the two segments have shown a significant rise. One is RPT with others and RPT with joint venture. RPT's joint ventures, to certain extent, this is explainable that some of the entities, particularly auto ancillary or for that matter energy segment, so they are getting into the new technology investment. That is still okay, but RPT others is different. Now, the second question about the rating, yes, it is for the not only restricted to the AAA or AA rated entities. We have found out that even for the BBB rated entities are RPT high. Just giving you perspective. So what we have filtered where the RPT exiting 25% of EBITDA. That's simply meaning that the RPT is higher than 25% of their EBITDA. The amount for the BBB rated entities is relatively small, but it is around 58% entities having such kind of RPT, which is a little bit concerning because BBB, that means their credit worthiness, that the credit quality itself is not very healthy.
Okay. And just one more number. You said the overall related party transactions in FY23 stands at 16 trillion. Right. Do we know what percentage of these are done by into entities, promoter entities, where there may be no strategic benefit to the corporate, or the control does not rest with the company. So, which is where you're concerned about. So, what number is that as a percentage of 16 trillion?
So one thing is that this is the exercise. It is more to do with the entity-specific number. On an aggregate basis, it does not show a very clear picture. It might so happen the amount is less, but for the entity where the credit matrix is low and having a significance here. Minimally, the number is around 20 to 25%, where we are saying that it needs to be looked. We are not saying this is a grave concern. We will be watchful. So out of those numbers 16, around 25% entities could have such kind of interest where the economic interest or the benefit accruing, it's not clearly visible.
And of that 25%, what percentage would be by the BBB rated entities?
It is small. It is small because, as I said, that the amount is not aggregate amount is not a very right comparison. Entity by entity would be a better choice.
Okay, all right. We'll leave it on that note, sir. Thank you very much for joining in and flagging this off. At least it's a trend that one must keep on the radar, the rise in related party transactions. Well, with that, we are almost completely out of time on this edition of Trading Hour. Leaving the markets looking slightly better because from red, the color has changed to green and the Nifty is now sitting on a gain of almost 36 points. We are at the day's high. That's where we take your leave. But the team of Halftime Report comes up next to carry the action forward.